The infinite banking concept, bank on yourself, becoming your own banker, cash flow banking, your family bank, there are a lot of names out there that really all revolve around a whole life insurance policy. But what does it mean? Well, the idea of the banking concept, call it, really teaches individuals how to use a whole life insurance policy as a financing tool. The best means to often illustrate this is real estate. So let's pretend for a moment that you own a piece of property and it appreciates at 5% every single year like clockwork. That'd be nice, wouldn't it? Now, if you own that home free and clear, will you continue to receive that 5% on the full property value? Of course, you own it free and clear. Now, if you have a mortgage or perhaps a line of credit outstanding against the property, do you earn the 5% only on the remaining equity or still on the entire property value? The entire property value. There's no lost opportunity cost. So how this ties to the banking concept and specifically a whole life insurance policy is in the sense that once a dollar passes through the cash value of a whole life insurance policy, regardless if I let that dollar sit and grow or if I decide to borrow against it, I will continue to earn interest on my entire cash value as if I never touched it in the first place. Let's demonstrate quickly. Let's assume that I have a whole life insurance policy that is paying a dividend rate of 5%. We'll assume that we have $200,000 in cash value, just like the real estate value that was appraised at $200,000. Now, if I let that money sit and grow, that 200K, what'll happen? I receive a 5% dividend on it. Now, if I elect to take a loan against the policy, let's assume I borrow half of the equity. So I've got $100,000 in cash value or remaining equity in the policy, and then a $100,000 loan. What'll happen here is the company will continue to pay that 5% dividend on any money still in remaining equity or cash value and any money outstanding in loans. I still earn a dividend on the full $200,000 as if I never touched it in the first place. Now, how insurance companies do this, there are two methods. One, they do collateralize the death benefit. We're going to show you an example here in a second. And then two, there is loan interest. Just like we would take a mortgage against a piece of property, if I take a mortgage or line of credit, there is a cost to borrow. Let's assume it's 3%. Over here, if I take a loan from a life insurance policy, if I go directly to an insurance carrier, I might see the loan at 5%. This interest on the real estate would go where? To the lender. Call it the bank. The loan interest on the insurance policy goes where? The insurance company. Let's take a look here. Let's demonstrate an example. So anytime we look at any strategies when we use a cash value life insurance policy, it is beneficial to see what it looks like if I don't touch the money first. This way I have a clean gauge to compare my policy to and see what the actual net impact of that loan is. So here we've got a policy on a 45-year-old male paying into it for 5 years, $50K per year. Now, he can fund for a shorter or longer period of time, but we wanted to stop all payments at age 50 in this example. The cash value is optimized. So we've got $150,000 in cash value here. Year 3, at that point in time, we've paid in $150,000. A goal that we have with everyone we work with is to maximize the cash value of a life insurance policy first and foremost. The reason for this is if my plan is to use it, to take control of, call it, the banking function in my life, well, I'm going to optimize the cash first. This way I've got more working capital there. So, breaking even year 3. Okay. Performance over time, all well and good. Here's what I want to compare it to. What is the impact on my life insurance policy when I take a loan? So, same exact policy, same break-even point. Difference here, we take a $200,000 loan out in year 5. So the impact of the policy is as follows. What I can pull from the gauge that determines how much I can borrow will be my cash value. So in the example where I did not touch it, my cash value was $263. I've pulled out a $200,000 loan. The cash value is now $53,000 over here. So I see a $210,000 reduction. The reason why, in this example, we took the $200,000 loan out. The loan interest is 5%. 5% of 200K is $10,000. And we made no loan payments or loan interest payments in that year when we took the 200K out. So I pulled the 200,000 out, and then the attractive feature of this concept is I'm still going to earn dividends on everything. And you can see it here, this column, my annual dividend column, does not change when I have a loan outstanding relative to the example when I paid money in and just let it sit and grow. How the company does that is as follows. I pulled out $200,000. How much did my death benefit drop by? $200,000. Anytime I take a loan from a life insurance policy, you will see a dollar for dollar reduction on your death benefit. That is what the insurance company is holding as collateral when I borrow from the policy. Meaning if I die with a loan outstanding, in this example, prior to the loan being pulled, they were going to pay $1 million. Now they're going to pay about $850,000. So I see that reduction there. That is really where the benefit comes into the insurance company. Now, as I repay the loan here, so we repay it at $50,000 per year. If we tally up those payments, we see that we paid back just about $229,000. That additional $28,975 was interest that did go to the insurance company. So if we stop here, this concept makes zero sense because I'm paying interest on my own money. However, where it works for you and I as the consumer is once it's paid back, what do you notice here? What's your cash value? $325,000. And then what is it in the example when I didn't touch it and just let my money sit and grow? $325,000. I see my cash value and death benefit, for that matter, fully restored to exactly what it would have been as if I never touched it in the first place. There's no lost opportunity cost. So really what the idea of the banking concept does is teach one how to use these cash value life insurance policies as a financing tool. Keep the compounding moving forward for you. So a lot of good can be done with this concept. What we'll teach individuals to do every single time, first and foremost, is how to maximize the cash value of a life insurance policy. So to demonstrate that, and we'll close with this, here is an example of 3 policies, 2 on a 35-year-old male and 1 on a 45-year-old male, paying in $50,000 per year. Now what you'll find here in each of the examples, what's highlighted in yellow is his break-even point. You know, the biggest objection why individuals do not practice this concept or do not open whole life insurance policies is often the cash value. How do I maximize the cash value from day one, though, which gives me more working capital from day one? And also what you will find in almost every single case is that it will maximize my long-term cash value as well, especially when I'm looking at the guarantees. So here are just a couple examples of optimizing cash value up front, breaking even early. This is very valuable if you've been exposed to whole life insurance before. Perhaps it was traditional whole life insurance that took 12 to 14 years to break even. World of difference here. And these are often the same policies, just designed in a manner where we've got the minimum insurance premium and maximum cash value from the get-go. So as always, I hope this helps. Reach out with any questions, and we will talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.